So friends, we can move to next unit, unit 17 of ABM bond investment. Friends, kindly subscribe this channel if you haven't subscribed yet for my handwritten notes. Forgive me for my old videos. In my old videos, I have given voiceover which was at high speed. So please hear that videos by decreasing your video speed by clicking at the three dots on the video. So friends, we can start bond investment. So if companies need cash for a short term, they usually borrow from banks, whereas if companies need cash for a long term, they issue bonds. They issue bonds. So they issue these bonds and raise money. Government also issue bonds in case of need of money. So government and corporates borrow money by selling bonds to investors. So they give these bonds to investors or the public and they borrow money. Investor receives fixed interest each year until maturity called coupon. It's called coupon fixed interest each year. At maturity, debt is repaid and borrower pays bondholder the face value of the bond. Bond issued by Indian government in Indian rupees are government bonds, whereas bond issued by a national government or for example Indian government in foreign currency is called sovereign bonds. That is, in home currency it is government bonds, whereas in this foreign currency it is known as sovereign bonds. Government has market risk but no credit risk. First, government bond issued by English government in 1963 to fund its war against France. So it was the first government bond. US government bonds is known as US treasuries. French government bonds is in euro is known as odds. German bonds is known as bunds and UK bonds is known as gilts. When market interest rate is greater than coupon rate, that is yield is greater than coupon rate, then bond sells less than face value. When market interest rate is less than coupon rate, then bond sells for more than its face value. For example, if face value of a bond is 1000 rupees, if n equal to 3 years, coupon is 6%, interest or market interest rate is 10%. Here interest rate 10% is greater than coupon of 6%. So present value equal to 1000 into 6%, that is 60 rupees. 60 divided by 1.1 plus 60 divided by 1.1 square plus 60 divided by 1.1 raised to 3. So we have to do this until the number of years. First year, second year, third year. Here 1.1 we got like 1 plus 10 by 100. That is 1.1. So the answer is 900.55, which is less than 1000 face value. That is interest rate greater than coupon. The present value is less than its face value. Bond sells less than face value. Next is yield to maturity or YTM. For example, 3-year bond coupon of 10%. Market price equal to 1000. Here first payment is 1000 rupees. Then we get interest of 100 rupees. That is rate of return is 10%. 100 rupees every year. And the third year we get back 1100 rupees. So rate of return is 10% itself. Let market price is 1136 rupees. So that is the price of the bond now is 1136. So we have to pay 1136 to get the bond. Then first year so coupon we get rate of return of 10%. Sorry, rate of return coupon of 10%. That is, the bond is having face value of 1000. So we, if there is nothing told about the bond, we have to take it as face value 1000. So we will get the coupon 10% into 1000 equal to 100, 100, 100 for 3 years and the face value back in the third year. So rate of return is 100 by the payment 1136, that is 8.8%. So as bond price increases, yield decreases. Bond price here increases to 1136 from 1000. So yield decreased from 10 to 8.8%. So here current yield is calculated as coupon by market price into 100. That is rate of return or current yield. That is, if market price of a bond greater than face value, the bond is at premium and will face a capital loss during its lifetime. That is return less than bond current yield. If market price of a bond is less than face value, it is at discount and will face a capital gain during its lifetime and return greater than bond's current yield. For example, market price is 900, then its face value is 1000, then the bond is at discount. So it will gain a capital of 100 rupees, that is 900 plus 100 gives 1000 rupees in its lifetime, and we get return greater than bond's current yield. So yield to maturity takes into account both change in bond's value over lifetime and current yield. 3-year bond coupon equal to 10%, market price is 1136 and YTM equal to 5%. Then present value at 5% is 100 by 1.05 plus 100 by 1.05 square plus 100 by 1.05 cube. This is an example. So we get 1136.16. So 1000 face value bond at discount rate of 5% has current market price of 1136 rupees. Next is rate of return. Rate of return equal to coupon income plus price change by investment. For example, investment is 1000 rupees. Coupon equal to 60 at 6% because 6% into 1000 gives us 60 rupees. Market price is 1008. Then rate of return, if we sell it now, equal to, we get 60 rupees now plus 8 rupees is the price change between market price and the investment amount, that is 8. 60 plus 8 by investment amount. Face value of the this bond, that is investment amount, is 1000. So we get 6.8% as rate of return. Now we know bond price is inversely proportional to market interest rate. If bonds YTM equal to constant, then rate of return equal to yield. If interest rate equal to constant, then bond price change with time. So rate of return equal to YTM. If YTM increases, rate of return less than yield, and if YTM decreases, rate of return greater than yield. This can come as MCQ in CAIIB exam. Risk in bond investments. So we know that there is always a risk in everything. So here there are 3 or 4 types of risk in bond investing. First is interest rate risk, IR risk. Market interest rate is inversely proportional to value of bond investment. So there is interest rate risk. Duration of bond. Holding period of the bond up to which there is no loss or gain due to change in interest rate is duration of the bond. It can be calculated as delta PV into T, that is the present value into its time and the sum of all present value into its time. Duration equal to delta PV into T by delta PV, and modified duration is duration by 1 plus YTM. Next is default risk. Here, default risk is also known as credit risk. Government won't go bankrupt, so there is no default risk for government, but there is market risk. But corporates have default risk. So companies offer high interest rate for bonds than the government. We all know that corporates are at giving high interest rate because they have this credit risk. There is there will be some time when corporates can default, can do so having default risk, this is called risk premium. The price or high interest they are paying than government is called risk premium. Bonds are rated by CRISIL, ICRA, etc. in India. So we can know which corporate bonds is selling at good price, or which bonds are of good corporates by checking the rating of CRISIL or ICRA. Variations in corporate bond. First is zero coupon bonds. Zero coupon means we all know coupon equal to 0. So we won't get interest for every year, but we get a redemption in face value. Uh, That is, after the expiry of the maturity date, we will get the face value of the bond, but we bought the bond at a price value lesser than face value, so the difference is our profit. Floating rate bonds, here coupon payment in is linked to some benchmark interest rate that is not fixed, so here coupon rate changes. Convertible bonds is converted into shares at a specified date in future. So an investor gets an opportunity to hold shares of a company in future, and these types of bonds are known as convertible bonds. Callable bonds are issuer has a right to call back the bonds. So this is investors is does not find this as a good option, as issuer can at any time call back the bond, and they pay a fixed price. When interest rate decreases, bonds are likely to be called back as bond price increases. So friends, that's all the main points from this unit. So if you haven't subscribed yet, kindly subscribe for this channel for my handwritten notes. Thank you, friends.